Just the standard disclaimer that you've been at any of my webinars before, you've heard me say before. This webinar is for informational, educational purposes, cannot be used to contest any IRS, New York State, or other penalties. We will work to answer any questions at the end of this webinar. And again, I thank you for the attendance to this. It's been a little while since we've had a chance to do a webinar. A lot of the PPP and other stuff calmed down a little bit. I'd like to think the majority of that is in our rearview mirror or getting there, but now we can go back to some other items, and there's always new stuff and new information to present. So today, what are we going over? We're going over New York State's pass-through entity tax, and really what every owner needs to know about this particular tax. On a really high level, it's going to be something that I think a lot of pass-through businesses are going to get some great benefit out of. And I think that overall, I would be anticipating that a lot of our clients and people that are on this webinar will probably be able to take advantage of all of this. So let's just start kind of going a little bit of a harmless self-promotion, as I like to do at the beginning of this. I am a tax partner at Cerini and Associates. Some industries that I specialize in include healthcare, financial services, technology, professional services, and I have some specialties in state and local taxation, ergo the New York State pass-through tax here, and in international taxation. And my email address is below. Should anybody have any questions at any point in time, feel free to reach out to me. I like to think I'm generally pretty responsive over email. So the New York State pass-through entity tax. So I have been emailing some clients and contacts back and forth about this since the guidance kind of came out Thursday. And immediately the first reaction is one of recoil. Ed, what are you telling me? There's a new tax I have to pay? Like, aren't I taxed enough already? I can see the look on people's faces, just, but even hear their reaction to it of, oh, more tax I have to pay. This actually is a taxpayer favorable item that is going to be helpful and is also optional. So let's never forget this is an optional item here. So what is this New York State pass-through entity tax? In one sentence, it is this optional tax that a pass-through entity can pay to New York State on behalf of its shareholders, which will be used to satisfy the New York State personal income tax obligation of its owners. So rather than you paying New York State tax for your share of your K-1 income, the entity will pay a tax for everybody's share of K-1 income, and you will receive a credit for that against your New York State personal income tax. So immediately, why would somebody do this? This was done as a response to the state and local tax SALT limitation of $10,000 passed by the Tax Cuts and Jobs Act. We all remember that limitation. We all know about it. I think for nearly every participant in this room, it sticks in their craw as a reminder of what used to be versus what's there. So you can only deduct up to $10,000 of imposed state and local tax, including income tax for any individual shareholder or property taxes. So this program, this idea was originally launched in other states, really in Connecticut in 2018, 2019, along with some other programs that came about as a response to the SALT limitation. If you recall, for about a 2-month stretch, New York State was trying to offer a charitable contribution in lieu of payment of income tax in order to allow a workaround for that. The IRS pretty quickly struck down upon that. New York State does have on the books, although I don't think a single entity does it, where you can elect to pay your employees portion of state and local tax and have them receive a credit. It is something that I don't think I've ever seen anybody really use this. or that option at least. This program, however, the one that Connecticut passed, the IRS in November 2020 came out and said, hey, this is allowable. We will allow this based off of the legislative history that we have, that you can have the entity pay the tax on behalf of its owners, have the entity claim a federal tax deduction for this amount, and the IRS will allow it. So now that in November 2020, this became, really allowable by the IRS, this kind of took off pretty quickly. A bunch of states already kind of had some floating around in or around this, this area, but very few states really did it. Connecticut was kind of the leader in the clubhouse. Since then, 13 other states now allow for these. Maryland, Connecticut, Rhode Island does, states like that. I know California, which is another big state for a lot of taxpayers, has a proposal for it. Let's see if that actually goes anywhere. But for, I would imagine, the majority of participants in the webinar right now, New York State is really their, their headquarters, their home, and we're going to really focus on that now. But as of right now, there's 13 other states that allow for this, and another 4 that are looking to do it. So it's catching on. It's catching on quick. I'll be very curious to see, where that moves on a go-forward basis. So let's talk about what the benefit is, right? Let's get to the, let's get to the bottom line right away as it comes to this. What benefit do the owners get? The owners get a federal level tax deduction on business income that can result on significant savings. So what I have here is a very quick sampling of what your federal income tax, or federal, or what should I say, your business income for federal tax purposes was determined without regard to this deduction, showing it at different varying levels. So that top line is how much your K1 income would be, and this is based off of a single filer that is not self-employment and is not a qualified business income deduction eligible. So real, just kind of basic scenario here, probably the most basic we could really get to. And I really just did that just to demonstrate the high level benefits here. So on 100,000 of K1 income to a taxpayer, they would get, for federal purposes only, very clear, much like bonus depreciation and other items, this is a federal only deduction. It does not impact your New York State taxable income whatsoever. You would get a deduction of $6,850 because that is the rate, 6.85%, that is paid for all income under 2 million. So it scales accordingly there. In the event you had 100,000 of K1 income, your original tax would have been $15,009. After you are able to take this deduction, your income would drop, your tax, federal tax, would drop down to $13,481. So a savings of about $1,500 on $100,000 of income. As you scale up this, the percentage benefit is going to get higher because you have a higher tax bracket that you are applying this against. Take, for instance, someone that has $1 million of K1 income that flows through either to themselves or to their partners. And again, this is a simple example just to show the level of benefit that's possible. $1 million of K1 income would allow for a $68,500 deduction, and as a result, a $25,000 reduction in their federal income tax bill. So we're talking real dollars here available to pass through business tax entity owners. So I can see a lot of entities from the smallest up to the biggest just really getting a benefit out of this. And it really is a program that I think we need to explore as you're doing your year-end tax planning with all taxpayers. Something that, because you see there's activity that you're going to need to do between now and the end of the year, some as soon as October 15th, some by December 31st, to really capture the benefits of all of these. And if your income was different, if there is a QBID eligible deduction, that 20% 199A business deduction, where you just take 20% off the top of your federal pass-through income. That can impact how much this benefits you, because you're actually going to be getting a slightly less benefit. If you are self-employed for tax purposes, meaning you are a partner in an LLC is the most common scenario, it could have a higher benefit because it'll also reduce your self-employment income. So this is just really the real baseline example of showing what could be possible here. Everybody's individual scenarios, because everybody, all the income goes in the pool together. If anybody has worked with me in the past, you've probably heard me say that before. Some of my staff who are on this webinar are probably tired of hearing me say that to people, talking about how taxes work in general and that everybody gets calculated together. So everyone's individual variables are going to matter significantly as it comes to how much this is really going to impact them. But we're able to at least ballpark to say, hey, is this worth exploring further? Let's talk about what entities are eligible. So the two groups of eligible entities are going to be partnerships and S corporations. So any C corporations, you won't receive any benefit out of this because you're not a pass-through entity. A partnership will include a LLC, a limited liability company, with more than one member that has not elected to be treated as an S corporation. So I would estimate that, probably just based on my experience, somewhere between 80 to 90% of all LLCs with more than one member are going to be treated as a partnership. It also applies to S corporations, including S corporations that have elected S corporation status. Those are what we're talking about when it comes to pass-through entities who are eligible to do this. Ineligible entities include C corporations, as they do not pass through to the owner and already get a corporate level deduction for state income taxes, and LLCs with one member that have not elected S corporation status and or sole proprietors, meaning your Schedule C filers, typically people who get 1099s, are broadly going to be a Schedule C filer. These are considered to be disregarded entities, which in tax terms means they don't exist and reported directly on the owner's return, and it's not considered a pass-through entity. So if you are a single member LLC, there may be some merit to considering between now and the end of the year electing S corporation status in order to avail yourself for this, among any other items that need to be considered. That's a relatively complex analysis, not one that is to be done lightly or simply, but this is now another variable that we need to add into the pool in order to think about, really how you want to pay this, how you want to play this. Let's now kind of talk about some of the pass-through entity mechanics. And some of this stuff is going to be a little technical to a degree. However, I find it to be very, very important that taxpayers are at least aware of what's going on. If you think about a tax return, you're the one that's going to be representing on this tax return that it's complete and accurate. You're the one who's kind of has their stuff on the line for all of this. So I want to go through and make sure people understand what is happening, even if it's behind the scenes. For many of you, this will be done by us, your tax advisors, or your whoever your tax advisor may be. We'll definitely be the ones leading the charge. Does not mean that you won't have some action items as it comes to this. And understanding what's happening, even on a high level, is as important as anything else, because you are the one who's ultimately responsible for nearly all of this. So that's why I want to kind of go through some of this stuff. So let's talk about the mechanics themselves. There's kind of 7 things we're going to need to worry about: an annual election, how the income is calculated, how the tax itself is calculated, the filing of the return, how the credits are allocated, how they are claimed, and estimated payments that may need to be made. So let's talk about the annual election. The annual election is likely going to be the single most intensive part for a business owner, meaning the rest of these steps will probably be more handled by your tax advisor. This step right here will be handled jointly, probably by you and your tax advisor, not by you individually. But it is something that needs to be considered for everybody. And this part, because it's going to be active on this part of the business owners, I'm going to go over a little more in depth. So the annual election needs to be made by a quote unquote authorized person on behalf of an eligible S corporation or partnership. New York State's guidance gives this nice little chart that says who it can be. Let's not go too deep into the procedural woods here. Simplest way, whoever is signing the tax return is going to be the person that's going to make the election. So if there's a managing partner, if there's a managing shareholder, if there's a president, so on and so forth, that's going to be the person who's going to do it. But conceptually, anybody who's able to bind the organization in contract will be able to make this election. The election, once it's made, is irrevocable, meaning once you decide to go down this path for the year, you're locked into this path for the year. I don't think that's necessarily a huge deal for many people, but just something to keep in mind that you really can't change your mind and say, you know what, I don't want to do this. Everybody's kind of on their own. Once you're in for good for that particular year. It's the year-to-year determination. So if I decide to do it for 2021 and I say, you know what, this is not what I thought it was going to be cracked up to be. This is more hassle than it's worth. This is not working for my organization. That's a 2021 only item. Each year is independently elected into. The election has to be made via the entity's New York State Business Online Services account. If you've ever filed a sales tax return or done a withholding tax or anything of that nature, it's the same exact account. If not, you may, I would say likely will need to create one in order to do this election based off of what I'm seeing right now. Let's talk about the deadlines here. For 2021, your big deadline is October 15th, 2021, meaning between now and October 15th, 2021, you need to make the determination that you want to do this, and you will need to make the election online. For years after 2021, the election is going to be due by March 15th of every single year. So, if any other accountants are in the room, you're probably thinking the same thing I did. Good. Another thing tied to March 15th that I need to worry about, along with estimated payments and, filing of these returns and so on and so forth. Let's just add one more thing to that day because we don't have enough pressure going on. However, that is how the law is written, and we have to abide by that accordingly. As of the guidance, there is no information in regards to late elections or recourse if you don't make election or anything like that, or the ability to extend the election. So absent anything in specific writing, this is a firm date as far as I can tell. If anything changes as they start to put more and more information out, we'll see what happens. But as of right now, you need to have that date circled for both this year and next year and going forward as to when you would need to make that election. So when we talk about this New York State Business Online Services account, the link is right here, and this is what you're going to see when that link comes up. So if you already have an account, you would hit login. If not, you'll need to create an account. Creating an account is not particularly difficult. It can be a little tricky if you are a partnership because you need to verify certain pieces of information in order to do so. Corporations, including S corporations, you just need a copy of your most recent filed tax return. Partnerships that are LLCs, you will probably need a copy of some payroll information and or a 5-digit code that New York State will send to you in order to verify all of this. It's a little tougher for these partnerships. I'm hoping they find a way to make it better for them, but they ask you certain information relative to your tax return, and they spell it out. And it says this line on this form on this page to get there. And it's pretty simple to do, but the partnerships can be a little trickier if you haven't done it in the past. So once you log in, you will then see the home screen that you will see for every other time you've logged in. The key item is going to be the services tab in the upper left-hand corner. That is where you're going to find the ability to do this election. When you click on services, you're going to see a drop-down menu that's going to exist here. If you click on either corporation tax or partnership tax, depending on how your entity is formed, you will then have the ability to click on this PTET web file. Now, I also noted when I was playing around yesterday trying to find information on this, that New York State has a special web page that you can go to that basically reiterates all of the guidance and includes a link for the election on there as well, which then leads you to the login. I know from my personal experience at New York State's intersite transfer, they can get a little wonky at times. So this is the route I would go, but if there's other routes, as long as it gets you to the same spot, I'm sure it's fine. But this is the method that I know, so that's the method I'm going to share with everybody. So you, depending on which entity you have, would click on that link, which will then lead you to this page right here. This now allows you to do the election. You can hit select right down here, which will then lead you to this information. You fill in the name, social, so on of the person who's authorized. You hit the acknowledgement, you hit continue, and then you hit submit, and that completes the election. As I was experimenting yesterday, many of our clients may know that we have a New York State online services account that we can link to clients, either to assist them with sales tax filings or other payments. I would say it's one of the standard procedures that we normally do when onboarding and or creating an entity for a client is we will add them to our New York State online services account. I noted that I was able to get to this screen in that account, but since I don't want to hit, full submission for anybody yet, I cannot 100% confirm that we will be able to do it via that screen, via our account. But based off of what I am seeing, I believe we will be able to. I think as we start to opt in, we're going to kind of learn in a trial by fire type scenario that we may or may not be able to. But my intuition is based off of what I saw that we will be able to use our New York State as professionals account to make this election for everybody, or for our clients, I should say. So that's how the election is done, and that may and likely will be the biggest active component for most business owners. But as I kind of stated, we still want to talk about the other nuts and bolts that we're getting into here. So let's talk about what is pass-through entity taxable income. That is the base that this tax is going to be calculated on. And this is going to include all, notice how I emphasized all, items of income, deduction, gain or loss that flows through to a member that pays New York State personal income tax. So if you have a partnership that has a C corporation or another partnership as a member, you would exclude their share of income in this calculation. You cannot pay this on behalf of a tier partnership or a corporate member because neither of them pay the personal income tax. You do not adjust for any limitations related to capital losses, passive activity losses, or basis limitations. So what that means is if you think about a capital loss, most individual taxpayers are limited to the lesser of $3,000 or their capital income for capital gains income for the year. So there would be a limitation. When you make this calculation, you do not take that limitation into account. You take the full amount of capital loss or full amount of a passive activity loss or the full amount regardless to any basis calculations. It is a relatively easy calculation, all things being equal. It really just kind of is your New York State business net income. The calculation is separate but similar for S corporations and partnerships. And like everything else in the world, the partnership one has to be more complex than the S corporation one, because if tax law professionals and tax law itself is not making partnerships more complex than necessary, then they're just not happy. So that's why you probably have two separate calculations as it results to that. So the S corporation one is probably the simpler of the two. Once again, it includes all items of income deduction, gain or loss that flows through to a member that pays New York State personal income tax. If you know anything about S corporations, you know that only certain people or there can only be certain shareholders of an S corporation. Typically, it's going to be a natural person. It can be a grantor trust that is disregarded that flows to a natural person, or there is something called an electing small business trust that can also be an eligible S corporation shareholder. By default, a partnership or a C corporation cannot own an S corporation. So the idea of having to exclude income is, for practical purposes, not really required, because everything should be a direct payer of New York State personal income tax, so you don't have to worry about that particular item. The instructions say that the net income must be apportioned to New York based on the S corporation apportionment rules. When we talk about the apportionment rules, what we're really saying is what percentage of your receipts are earned in New York based on New York's rules. New York is what's called for S corporation purpose, a market-based state, meaning it is where the benefit of the services are delivered, where the goods are delivered, et cetera, et cetera. That's the market of it. Under the guidance, there is no need to determine residency versus non-residency status. And I highlight this because a New York State resident is allocated 100% of S corporation income for personal income tax purposes. However, the guidance is indicating that the allocation is based on the S corporation's New York allocation. And that is a departure significantly from how the individual will pay it and how the partnership law one works. And that could present significant drawback to this for an S corporation that maybe only has 35% of their receipts located in New York, but has New York resident owners. They're not getting that same level of benefit that they may otherwise. Now, allocation is something I could do a whole separate topic on, and I think by the end of it, if I had 50 attendees, I'd say I'd have about 5 left because they'd be bored out of their minds, and it's super technical stuff. But on a real high level, just so people are aware, allocation is not a zero-sum game, meaning you can have the same sale allocated to 2 states, and you can have the same sale allocated to 0 states. The pie doesn't have to equal 100%, which is just a quirk of that, but something that is coming up here on this S corporation item here. So I have a very simple example just to show how the PTE, the pass-through entity taxable income, is calculated here for these purposes. So if I look, I have an S corporation owned by 2 individuals, 50% each, and I have scenarios 1, 2, 3, and 4. On all scenarios, I should say, they have the same gross receipts, the same cost of goods sold, and the same deductions otherwise. So on my most basic scenario, I have 2 million of receipts, 600,000 of cost of goods, 1.2 million of deductions, meaning that my pass-through entity taxable income pre-allocation is 200,000. And for scenario 1, I have a simple 100% allocation. So that means my PTE taxable income is 200,000. Scenario 2 shows the same exact variables, except it has an 80% allocation, which under the guidance means 160,000 of income will be allocated to the PTE taxable income. Scenario number 3 and 4 both have 100% allocation, but what I'm demonstrating here is how this capital loss item would work. Under scenario 3, there's a 150,000 capital loss that would normally be limited to the lesser of capital gain income or $3,000. For this calculation, we ignore that limitation, and our PTE taxable income is 50,000 when I add that 150,000 loss in. With 100% allocation makes it 50,000 pass-through entity taxable income. Scenario 4 shows the same items here, but with a 250,000 capital loss. making my net income zero, and therefore I have zero PTE taxable income. However, if I looked at the K-1s and the personal tax returns of these individuals, given the capital loss limitations, it is substantially likely that they would have New York State income tax imposed on this income, even though they have an overall net loss because of those capital loss limitations. We don't care about that though for this particular item, and that's really what I'm trying to demonstrate when it comes to this. So that is how you would determine the pass-through entity taxable income for the S corporation. It's pretty straightforward. It's pretty vanilla. Let's now talk about the partnership side of the coin. Once again, I'm highlighting the same thing here, just kind of drive this point home. It includes everything, but it has that limitation that it's to a member that pays New York State personal income tax. A partnership can have just about anything own it. So you would exclude another partnership, an S corporation, or a C corporation that owns the partnership. An interesting quirk I found is that this also includes any guaranteed payments that are allocated to partners. A guaranteed payment is a partner's way of receiving compensation without regard to the income of the partnership. Simple terms, it's kind of like a partner's salary that's not on W-2. It's the easiest way to think about it. But it does include that in that calculation, which I thought was very, very favorable. For the partnership, you have to break then the income into two pools, a resident and a non-resident base, based upon the residency of the owner. A resident is allocated 100% of income because they have 100% tax liability in New York State as a New York State resident. That's what I was just pointing out about the S corporation, that S corporation resident owner has the same 100% allocation, but per the guidance, it may not be able to take 100% of that based off of what we see. The non-resident pool is then based on New York State sourced income. So something to note is that the laws for allocating income for a partnership are different than the laws for allocating income for an S corporation. And not to get too boring on this either, it uses a three-factor allocation, meaning it uses the sales, it uses the property, and it uses payroll. And the rules for services are different. It's actually where the services are performed, not where the benefit is received. So it is a different allocation percentage than you would see on an S corporation, a little more of a pain to calculate, and it can have some different items. Once you have your two pools, the income within the pools is then allocated to each partner based on their relative percentages inside of each pool. Meaning you look at the entire pool for residents and say, okay, this guy has X%, this guy has Y% of that particular pool. You allocate X and Y% in that particular pool to those people. And I'll go over an example of how that all works. So here I have a partnership owned by three people, two New York State residents, one New York State non-resident, at 50% for resident one, 35% for resident two, and 15% for the non-resident. I have the same four scenarios in terms of income with gross receipts, capital gain, cost of goods, and deductions, but I also have a $100,000 guaranteed payment to resident one, who is a New York State resident that owns 50%. So my total pool is still 200,000 as we look at all of that. So the resident pool is going to be first allocated between the gross receipts, capital gain, cost of goods, and deductions, which adds up to 100,000 when I add the guaranteed payment in place. And I have 85% of my income is to residents, 15% to non-residents. So that means my ordinary income is allocated 85,000 to the resident pool, 15,000 to the non-resident pool. The guaranteed payment, because it is paid to resident one, is allocated to the resident pool. So that's how I get my 200,000 and how it's split in scenario one. You see, I have the residents, they get their 85%, the non-resident gets his 15%. The guaranteed payment is sent specifically to the person who earns it based on their residency status. Scenario 2, 3, and 4 flow is similarly to how the S corporation worked, where in scenario 2, I have an 80% allocation factor, so my non-resident goes from 15,000 to 12,000. In scenario 3, you have an interesting quirk that's coming up here based off of that capital gain, that I have an ordinary loss of 50,000 when I take into account that guaranteed payment, but I have the resident who has the 100,000 guaranteed payment, making my everything being allocated to the resident pool, nothing being allocated to the non-resident pool. Finally, you have scenario 4, where there's a complete loss. And again, this is designed to show that there is zero allocation as it comes to all of that. So now let's talk about these interpool allocations, which sounds more complex than it is. It's basically, if you had to draw it up, it's the way you would draw it up in the most common sense manner, which is pretty rare for tax, generally speaking. So I look at my resident pool, and I have to look at my relative percentages between these two guys, which are 81% and 19%. So resident one has an allocation of 50,000 of ordinary income plus 100,000 of the guaranteed payment. Resident 2 has 35,000 of the ordinary income, making the total 185. So he has 81% of the pool. Resident 2 has 19% of that pool. That's how that interpool allocation works. It's just based off of how much each person got and what percentage each person got. On scenario 3, they didn't cover what would happen when you have a loss on one pool and a income on the other. I think that's because they say once you get below 0, it's considered a 0. So therefore, it gets 100% allocated to the pool that has the non-zero. I would like to see a little more explicit on that, but that's going to be how it's going to end up working based off of how that guidance is written as of today. So again, these are how those interpool allocation works. And these percentages matter for when we calculate the tax and the credit itself. So now, broadly speaking, we covered how you calculate the income. It's really just based off of the income of the entity allocated to the members in the most straight line way you possibly can allocate it. Does it sound a little convoluted when you talk about it? Yes. As you start to do it, you're going to see that they really kind of just followed the math on it in what can be the simplest way you can execute something this complex. Let's talk about the tax itself. So New York State has 4 levels of tax. For anything less than 2 million, it's 6.85% of the PTE's taxable income. 6.85% is the New York State tax rate that most people under 2 million are going to end up paying. Once you get over 2 million, the band between 2 and 5 million is 137,000 plus 9.65%. The 5 million to 25 million band is 426 plus 10.3%. Greater than 25 million is the 2.4 million plus the 10.9%. These are updated for those new New York State rates for high income taxpayers. So happy they were able to at least figure out how that worked here. So let's now look at how much tax would be imposed on each of these entities based off of the income that we calculated just prior. So in scenario 1, both of them had 200,000 of PTE income. It would be 13,700. In scenario 2, they had 197,000 because of the allocation factor. It would be 13,495. In scenario 3, it would be 57,000, which would be 3939. And in scenario 4, we had no PTE income, so we have no PTE tax due. That's how the tax itself is calculated. We'll then go into how it's passed out to the members momentarily. But let's first cover the entity return itself. So this is this pass-through entity tax is going to be filed on a separate return. New York State has said nothing, but it's going to be a separate return due March 15th. They haven't given forms, they haven't given anything on it other than a deadline and saying it's a separate form. March 15th, as you know, many of you probably know, is the day that the S corporation and the partnership tax returns are going to be due. So at least you have a similarity across the board. And March 15th also was the deadline for the current year election. It's a big day in accounting land. You can file a 6-month extension. So if you extend your business tax return, which I would imagine most people do, considering that it flows through to their personal tax return, and further, because of some federal changes, extending partnerships actually makes a lot of sense in case you need to do an amended return during the year. It is substantially similar to do if you have an extension versus not having an extension. But that's neither here nor there. But you can also get an extension on this. However, you cannot amend this return. So once you've done it, you're in, that's returned, whatever you've paid, you've paid. If you need to make an amendment that affects your taxable income for New York State purposes, that would then flow down to the members, and any overpayment or underpayment would then be reflected within the members' individual tax liabilities as a result of that. New York State guidance right now says it'll be filed using an online return application. I don't really know what that means. I don't know if they know what that means. I'm very curious. My anticipation is that it will be included within the IT 204 for partnerships or the CT3S for S corporations, and it will be eligible to be filed via our tax filing software. I can't imagine a scenario where they want to have separate competing systems like that. It would just probably create nightmares for us, nightmares for them. So I would anticipate, based on how the Connecticut version works, how the Maryland one that I've seen works, and other ones that are in place, that it'll be part and parcel to the New York State tax return you already file. Doesn't mean New York State can't go around and surprise me, but that's really what I would be anticipating as it comes to the actual filing of this return. So let's talk about how these pass-through entity tax credits are now allocated to the members, right? We've calculated how the tax works. We get a federal deduction because the entity is going to be paying the tax. How it's allocated is going to be based on the entity. Once again, S corporations are very, very simple. It's just based off of your straight percentage ownership. So if you own 7% of it, you get 7% of the tax credit that is calculated. Simple, easy. I don't think there's a whole lot to really cover there. On partnerships, you have to allocate the credit between the non-resident and resident pool, meaning you look at how much of a percentage goes to the resident pool, how much goes to the non-resident pool. That's the first percentage you allocate. And then if you recall those interpool allocation percentages, you then allocate it based on the relative percentages within those pools. So very, very simple example using the same exact items that we had in our prior example. Same 4 levels of income, same 4 levels of pass-through entity tax. For the S corporation, it's a 50-50 S corporation. It's a 50-50 split. Not really a very controversial or much to really think about when it comes to that. For the partnership, again, we have to first break out into the non-resident pool and the resident pool. Those are the percentages that we calculated earlier based off of how they were allocated. So in scenario 1, 92.5% was in the resident pool, 7.5% was in the non-resident pool. We then have to allocate within the resident pool between resident 1 and resident 2 based on their percentages. So resident 1's allocation is the total tax, the 1, times the allocation percentage, 92.5, times their allocation, their personal allocation percentage, or 10,275. Resident 2's allocation is going to be 1 times 2 times 5. The tax times the resident pool allocation percentage times his individual allocation percentage. For non-resident, it's going to be 1 times 3 because we only have 1 non-resident here. But that's broadly how it works. You allocate the relative percentages and you use it on a percentage basis person to person. They get the credit for that. So now, how do you claim this credit? New York State said, oh, it'll be on Form IT 653, which is yet to be released. So if you search for IT 653, all you see is a bunch of Post-its right now. It started to have a little more SEO related stuff where people have put out guidance on this. You're starting to see their articles on there as well. But I thought about this slide when I first started reading about this and tried to find this form, and I wasn't going to change my mind after my initial idea. So right now, we don't know what that form actually looks like when it comes to how it's going to be claimed, but I imagine it's going to be pretty basic, pretty vanilla. Here's an important point. Any excess credit will be treated as an overpayment, which can be refunded or applied to individual estimated tax for the following year. Meaning, let's say you have a partnership that has $4 million of income. So it's going to be in that 9.65% band, but your share of that is only, maybe 1, 2, 3, 5%. So your individual allocation is in the hundreds of thousands and you're at the 6.85%. You'd have a separate rate between those two. If they were to apply this the same way they apply a resident credit, which is something that some people thought may have happened with this, that would result in any overpayment kind of just being lost, which is, I wouldn't rule out New York State doing that, but that would be super unfriendly relative to what I think they're trying to accomplish here. So this is just treated as an overpayment, which can be refunded or applied to the individual estimated tax for the following year. So there's no risk of you paying too much on the corporate side and the shareholders not having to get any overpayments refunded back to them. That risk is completely mitigated, but that was a concern we initially may have had. So let's now talk about the estimated payments, then a couple quick open items, and I say I got 3 or 4 questions floating around as well. For estimated payments for 2021, you're not going to make any. New York State said, yeah, this is new. We're still figuring it out. No estimated payments are required. However, New York State has said they will make an optional and online estimated payment available by December 15th, 2021. Why is that relevant? Because cash basis taxpayers, which would be the majority of flow-through entities, will need to pay this by December 31st, 2021 to deduct in 2021. So New York State is kind of playing the Grinch that stole Ed's Christmas vacation, because I'm sure we're going to have to deal with this for a lot of our clients between December 15th and December 31st, which is going to be interesting because I don't know if I necessarily trust New York State to execute this by December 15th, 2021. Let's see what happens. I've been wrong before in my life. That's our 2021. For 2022 and beyond, you'll have to make quarterly estimated payments on 315, 615, 915, and 1215 based on either 90% of the current year tax or 100% of the prior year tax. If you've made estimated payments individually, those two standards should feel very familiar to you. For many people, it's 110% of the prior year tax to be in the safe harbor. For this, it's only 100% of the prior year tax. But we have to start thinking about that as you think about your cash flow on a go-forward basis. What kind of payments you need to make between December 15th, December 31st, in that time frame for your 2021. And thinking about 315, 615, 915 of 2022 going forward, how much cash flow you need to have available. This may require you to adjust what your shareholder or partner distribution schedule looks like as a result of all of this. So let's just hop into some quick open items that are still, some questions I still have, just open points that I see out there. How will resident S corporations be allocated? Will it only be New York source or on the full amount? Again, I highlighted this in the middle of the presentation, but it suggests that only the New York State allocated for an S corporation will be allowable, which is a different treatment than partnership and not nearly as beneficial for the resident S corporation owners. How about an investment holding partnership? A lot of clients will have a company they form to hold various private partnerships they invest in for various purposes to make their life easier. These normally aren't considered quote unquote trade or businesses under the tax code. So Are they going to be able to deduct this? Because as of the Tax Cuts and Jobs Act, expenses of these partnerships are currently non-deductible. So I'd be very curious. That's going to be an IRS-related guidance piece, not so much a New York State-related guidance piece. That notice the IRS gave that blessed this said that they will be issuing regulations at some point to affect this, but they wanted to give the head start. I kind of hinted at this already. Will New York State actually get the forms and payment out on time? Who knows? Their track record isn't exactly stellar in this regard. Let's see. Will the pass-through entity tax be able to be filed via tax prep software? I believe it will, but time can only tell on that one. And then finally, I wonder if New York State will expand this to cover New York City personal income tax and the Metropolitan Commuter Transit tax, which are both collected on personal income tax return forms. I mean, New York City personal income tax in particular is a real interesting one because for nearly all intents and purposes, it's treated the exact same way as a personal New York State personal income tax. So that's a pretty easy expansion to do just based off of residency. So I would be very curious how, if they're going to expand it to that, because I think that would help taxpayers significantly. So those are all kind of the open items that we have right here. So that said, I see we have some questions that have popped up. So can a fiscal year entity get this benefit for calendar year 2021? So there are special rules for fiscal year entity, but typically, as I read them, the fiscal year should comply to the PTET is a calendar year only item. And the calendar year that you file it should be based off of when the fiscal year ends, is my understanding. I didn't look too deep in that because it's very rare. I don't think I've ever actually seen one personally. A pass-through entity would have a fiscal year. So I don't think that's going to matter for tax purposes, but I'd have to double check how the fiscal ones work because I didn't pay too much attention to it as I read through the initial guidance because they're very, very rare. Does the New York State S Corporation shareholder add back the New York State tax deducted on the federal form on form CT 34 to the IT 201? So yes, you do add back the federal tax deducted, whether it's on form CT 34 or wherever that works. I'm sure the tax prep softwares and or the instructions when they come out will give the exact mechanics of that. But big answer, we believe that it'll flow through as an add back to personal tax returns for New York State purposes. This is a federal only deduction. Can a CPA make this election as the administrator? Yes. We believe so that is possible. They cannot be the authorized person, but it looks like they are able to via their New York State Online Services account. If they have it linked, they should be able to do it. I think as we start to go through it, we're going to learn pretty quickly if you can or not. The functionality was there. I was able to get to the screen that included the ability to do that. So we'll see how that works. The quarterly payments will be in lieu of paying estimates on that income personally. Yes, correct. Think back to the initial crux of what this is. This is a payment by the company to satisfy the personal income tax requirements of the individual shareholders themselves. So if the company is paying it, you would no longer have to pay quarterly estimated taxes on that particular income. As far as 2021 cash basis payments due 12/15/2021, if the owners have already made personal estimated payments, will they be able to reapply those payments? No, New York State has specifically stated that any personal payments that have been made do not apply towards this. So if you've already made personal payments, those would get refunded when you file your personal income tax return if your entity were to opt into this. It looks like someone is saying that they tried to do the election for a client on New York State Online Services as a representative professional and weren't able to do so, which is kind of annoying because I imagine many clients are going to want our help with this. But if that's the case, again, I haven't gone through to completion on it. I only went through the initial steps because I wasn't going to opt somebody in without first talking to them and first analyzing everything. So it seems very possible that each individual client may need to create their own account, which when you're dealing with a partnership can be a little annoying from time to time. So that said, if we have no other questions, if you anybody else has anything that pops up, if they have a chance to review this afterwards or just want to follow up with me, please feel free to shoot us an email. We are recording this. We will probably have this available online within a day or two, depending on other things going on. I thank everybody for their attendance and hope to see everybody soon. Thank you.